4 hours is much. Interesting. Okay, that's fine. So we'll continue our class, right? Okay, what are the problems using Gordon's growth model? Gordon's growth model is just like, you know, there is so many assumptions to that. You see, it makes use of accounting profit, right? It assumes that B, R and B is constant. It places reliance on accounting profit, and accounting profit can be what? Can be subjective. Okay. Accounting profit are what? Are subjective, right? So, and you can check if they say, oh, what are the problems of or disadvantages of using Gordon's growth model is subjective. And the effect of inflation may distort the accounting rate of return, right? Because from there you talk about the profits. Yes, you talk about the profit as well, because if you buy if the price of goods increases, the expenses may likely actually increase this as well. So with that, it will actually affect your profit. So, and these are the problems Gordon's have. So let's quickly move to the another method class. Another method of calculating cost of equity, right? If you don't use the dividend valuation method, either with equity, with what is it called? Either with growth or without growth, right? Another method is what? The capital asset pricing model. Now, the asset pricing model is used to calculate what is minimum return on investment. Don't forget that all these things are what investors are expecting from their investment. It is a cost to the firm. It is a return to you as the holder, because you are expecting something from your what? From your investment, right? Now, the cost of equity, using the capital asset pricing model, when we get to portfolio theory, where we will look at a lot of things, right? Capital asset pricing model is a branch in portfolio theory, right? We'll get there. Now, the cost of equity is calculated as equals to RF, right? The RF here is the risk-free assets plus the beta, that is the beta, equity beta, open bracket, you see the bracket, market return minus risk-free, right? And that is it. Or what from your question? If risk premium is given, so you can as well calculate the cost of equity as well. Cost of equity equals to risk-free plus beta, right? Then the risk premium. If risk premium is given. Now let me quickly do analysis of this formula. Your risk-free. Now that is one of the assumption of capital asset pricing model. It assumes that you are investing in a risk-free asset. That is purely an assumption. If you are to use capital asset pricing model to determine the cost of equity, and you are telling me that, oh, it's a risk-free asset. Please, is equity a risk-free asset? It's an asset, oh, but it's not risk-free. When you invest, okay, let me use okay, let's quickly look at a practical illustration now. Practical illustration. I invested before the CBN capitalization, I bought Fidelity Bank shares, right? I think at the rate of 10 naira per shares then, or I can't even remember, right? So immediately after the CBN recapitalization, because of course information affects share price, of course. Now, immediately after the CBN recapitalization policy, I already know that it will have effect on the shares, right? So the share I bought at the rate of 10 naira dropped to 9 naira, from 9 naira to 8 naira, thereabout then. I think so. Now, what I'm saying is that I make a loss on that investment. Is that not so? Is it a risk-free asset? If it is a risk-free asset, I invest 10 naira. Definitely I will get like 11 naira. I will surely get my money because it's a what? It's a risk-free. But it's not a risk-free investment. You can see I make a loss. So that is one of the assumption of capital asset pricing model. It assumes that you are investing in risk-free assets. Now, another name for risk-free in the question, risk-free could be treasury bill or government bond. That is risk. They may say, oh, the risk-free, what is it called? The AA Nigeria Limited have a treasury bill of 4%. That is what? risk-free. Don't forget that all these treasury bill government bond, when we get to bond valuation, you can see treasury bill now is a risk-free asset, right? Because when you invest in a government treasury bill now, right, whether government make loss or you will get your money, but this is not applicable to equity, right? I hope you get that. Now, equity better, right? That is the better factor. When we get to risk adjusted cost of capital, we will still explain more on better factor. That is the better factor. That is the equity beta. This equity beta here measures systematic risk, right? Beta factor means is a risk, right, that affects the shares, right? Now, what is it called? What capital asset pricing model assume that the only risk that affects your shares is systematic risk, which is the beta factor, and the assumption is totally wrong. The question is, what is systematic risk? Now, systematic risks are risks that affect affect everybody generally. You talk about inflation, you talk about the exchange rate, you talk about the unemployment. These are business. So capital asset pricing model assume that the beta factor that affects your shares are systematic risk. So it's an assumption, right? That is another problem of what capital asset pricing model, right? So when we get to portfolio theory, right, we will explain more about beta factor less than one, beta factor what greater than one. What is the implication? You, as an investment analyst or financial analyst or as a CFO, look at yourself. When you have a beta factor of a company, probably Apple stock for instance, that is less than one, what is the implication? We'll get there. Now, the LP, which is what the risk premium, right? Premium means that additional gain you get from investing in a risk in a risky asset. That is premium. The difference between your market return minus your risk-free asset, right? Minus your risk-free asset will give you what? Your risk premium. So the premium means that it's just like a compensation to you that, oh, because you are investing in a, okay, what you get in addition in investing in a risky asset, right? That is what we call what, and that is what we call what, risk premium. And that is all. I don't need to show you advantages or disadvantages of. See, from the formula, you should be able to what? Identify advantages of all this model, right? Because it is glaring that this may not be applicable here. Look at what we talk about risk-free assets. That is one of the assumptions of capital asset pricing model, right? Right? You can see another problem is that you see beta factor. It assumes that the only factor that affects your shares is only systematic risk. So what about unsystematic risk? Right? What is unsystematic risk? Unsystematic are risks that affect individual company alone. Now, the unsystematic risk that is affecting AA, right, is different from what is affecting BB. Now, what are these risks? Maybe I'm producing bread. This person is not producing bread, right? Now, I'm producing bread, maybe machine breakdown now. It's an example of one systematic. It doesn't consider that it will affect your shares, right? Which is very important. When we get to our portfolio theory, we will talk more about unsystematic risk as well. So, and that is all about the method of calculating cost of equity, right? Either using the dividend valuation method with growth or without growth, as well as what using the capital asset pricing model. Distinguished professional colleagues, I think we'll be able to do justice to the cost of equity first. So in our next class, right? In our next class, we'll talk about debt as well. We'll talk about debt. So I've been talking about debt. We'll look at the step-by-step approach to solve. We'll look at what is it called? Well, we've already established the cost of equity. After that, we'll talk about the cost of debt, right? We'll talk about the cost of debt. So once we talk about this cost of debt, we'll talk about the weighted average cost of capital. We'll talk about the step-by-step approach to solve weighted average cost of capital, or step-by-step approach to solve cost of capital. Generally, you see it. And also, it's also on the YouTube, right? It's also on the YouTube. I will just refer you to the YouTube. Check cost of capital. Everything you need to know about cost of capital is also on the YouTube channel, right? So, please, if you have any question, you can unmute your mic and ask your question. Question, please. Hello? Are we still together? I'm not sure. Hello?